Hey guys, I wanted to share with you something I made this week. We had some friends who ordered some strawberries for one of their grandkids, I guess, fundraisers, and they were out of town. So they asked me if I would do something with those strawberries. Guys, I made strawberry preserves. And I guess the point of that is don't ever stop learning things. I've never made strawberry preserves before, but I am so glad that I did. I had them yesterday morning as well as this morning, and it is so fresh tasting. I love them. And so anyway, never stop learning. That's what this is all about, and that's what our channel's about. It's about learning about investing. If you've come to this channel looking for the top 10 stocks that you need to buy, you've come to the wrong place. What we do here is we try to learn about investing. Now, there's a lot of stocks that we talk about, but that's not the purpose. The purpose is not for you to do what I do. The purpose is for us to learn together, to create our own style, to create our own investment process. So with that, let's go ahead and get kicked off because I am really excited about this topic. So I'm going to go ahead and share this on the screen. Investing versus gambling. Now, let me tell you, this kind of kicked off in my head last night as I had a lengthy discussion with somebody here at my house, who said, hey, I heard on some radio program or some podcast that, somebody who researches sports teams or boxers or MMA fighters, and bets on them. That's just exactly what you do in the stock market. And I'm like, I don't think that's exactly what I do. So we had a long discussion about that. And I wanted to share some of that with you guys because I feel it's an important topic. And as we kind of work our way into, this world of investing, I think it's important to understand whether we're looking at investing from an investing perspective or whether we're looking at it from a gambling perspective. And then, so when to know the difference and when to do either one. Okay. So let's go into the next slide here. So first of all, we're going to talk about definitions. First definition is, what is investing? Well, investing is the act of committing capital to an asset like a stock with the expectation of generating income or profit. So that's really what an investment is. Another key point is that investing looks at the long term and seeks to build a portfolio of growing assets. So that's kind of what investing is. What is gambling? Gambling is wagering money on an uncertain outcome that statistically is likely to have negative results. So why do I say that? Why do I say it's statistically negative results? And it's because it's short-term focus, first of all, but many times it's tied to a win-lose event. So if you're betting on a football game, for instance, that football game will end at some point, and you either win or you lose. It is not, so in the world of investing, you can invest in a company and wait for it to actually come to fruition based on your investing thesis. So let's go to the next one. So odds are, this is where it gets kind of fun. Odds are, in general, gamblers will likely lose money over the long term, and that is because the house rules tilt the odds in their favor. So when you're at a casino in Vegas, you can rest assured that the rules of the house will tilt toward their favor. When you're investing, you will likely make money over the long term, and there's some historical evidence for this. So let me put up the slide of the S&P 500 for the last, I don't know how many years that is, 40 years maybe. So you can see that over the 40-year period, the stock market has gone up. So if somebody invested 40 years ago, left the money, didn't do anything with it, they are making tons of money today. So historically, there's a historical evidence that we will make money in the stock market. That doesn't guarantee that it'll be that way in the future. You all kind of get that. we just don't know what the future holds. But if we look at the past, we do have some evidence that we will likely make money in the long term. But you also see in this slide, there's some peaks and some valleys and some peaks and valleys. And then there's this long run and then a big deep valley for the pandemic, and then a huge move upward and then back down. So a lot of times people will try to catch those peaks and valleys. It's called timing the market. I would suggest that we can't win timing the market. And I found a slide that I think tells the story. And that's this one here. And if you look at this slide here, and I'm not sure if you can see that on your screen or not, but let me just read it to you. This is the risk of missing the best days in the market from the year 2000 to the year 2019. So roughly 20 years. If you were invested for all 5,035 trading days of that 20-year period, you would have a return of 6.1%. If you missed, because you wanted to time the market, if you missed the 10 best days, now remember, a lot of times what will happen is that the market will crash. And then for some reason, the market will come back because everybody realizes, maybe we overdid that, right? So you're looking, usually those are the best days. It's when they're trying to recover from a crash. But if you come out of that and then you don't get back in time and you missed the 10 out of 5,035 days, your return was only 2.4%. So you were almost 1/3 of what the return would have been had you just stayed in the market. The next one is you missed the top 20 days. 20 days out of 5,035 days, your return was basically nothing. And then it gets worse. And I won't go through each one of those. You kind of get the point. But if you look at missing the top 50 days, that is 1%. You were invested 99% of the time for the last 20 years, but you missed the 50 best days. Your return was actually negative 5.5%. So that's evidence that we shouldn't try to time the market. So you won't see me coming in and out of stocks a lot. You won't see me coming in and out of the market a lot, because at the end of the day, I want my money invested to catch those up days. It is those up days. Basically, if you think about this, if you were not invested for 99% of the time, but were invested on those 50 days, your return would be pretty good. So, I guess from my perspective, I can only talk to me because I'm the one in charge of my portfolio. You're the one in charge of yours. But for me, I try to stay invested as much as I can. And so when is investing most like gambling? Well, first of all, when we're trading for excitement rather than using a methodical and, in my words, boring process. So if you are doing it just for the adrenaline rush, you're doing it for the excitement, then you can pretty much count on the fact that you're beginning to gamble with your investing dollars rather than investing. Investing typically is a pretty boring process. You have your due diligence process. You buy the stock, you don't time it, and you just kind of hold it there, and then you keep adding over time, right? That's pretty boring. So when is investing most like gambling? It's when we're trying to do things to generate excitement or to generate additional returns. And then also when we're trading to win rather than investing for the long term. So if your thought is, hey, I'm going to make this trade and I'm going to win in the next week, I'm going to win in the next month, then that's you're no longer thinking about investing. You're really doing more of a gambling. So I want to find out what you guys think about this quote from Warren Buffett. And I'll let you know that I really struggle with this quote. I know how successful he is, but I also know that he doesn't follow this in his portfolio. But he gets credit for this quote, and it is rule number 1, never lose money. Rule number 2, never forget rule number 1. So in essence, what Warren Buffett is saying there is that you don't sell it when you're losing money. You wait for it to make money again. So let's talk about that. I want to hear what you guys' thoughts are on that. So what are the takeaways? Takeaways are you get to determine your style, the investments in your portfolio. So you get to choose all of that, right? So that is your job. It is important to stay engaged and interested in investing, meaning that sometimes we add some excitement to the portfolio. Sometimes, when you cook a nice steak, it needs a little seasoning on the top. And so sometimes having a little bit of gamble in there creates a little bit of excitement, but it shouldn't be you don't want to eat a lot of spices. You want to eat meat with some spices. So hopefully that makes sense. And that was not an analogy I worked on for this program, but I think it works. So many people have gambling characteristics in at least some of their portfolios, and I am no different. So I wanted to share those with you. So maybe as an illustration, right? So as an illustration, I have gambles, what I consider gambles on ADM, Archer Daniels Midland, as well as to a lesser degree, Pinnacle West, which is a utility holding company out of Arizona. So those are my gambles. And so why are they my gambles? First of all, well, maybe not why are they my gambles, but this points out that even my gambles, I don't think are asymmetric. So what does asymmetric means? Symmetric means that there's an equal distance between the making money and losing money. That means you got a 50-50 probability, right? I believe in both of these situations, I have a greater probability of making money than I do losing money. And that's just the way I like to gamble. I don't like to lose money. So ADM, I have 1,000 shares of that. It's 3.6% of the portfolio. And right now I am up 2.5% on those shares. But as you know, maybe you're following this, maybe you're not. If you're not, ADM has this issue going on with its financial statements. They delayed issuing their financial statements, but tomorrow they are going to issue those financial statements in the morning before market opens. So we will get to see how this gamble paid off. So why do I believe it's not asymmetric? First of all, when there is uncertainty in the market, investors will always think the worst, and they will therefore drive the price of the shares down to a place where it is the worst possible scenario. Now, it could actually be worse, but we've gotten some feedback from the company that doesn't seem like it's going to be a terrible thing. So I think the expectation of shareholders is under what it really should be, right? So I think that ADM, once they clear up some things tomorrow, and it won't all be clear, but as they clear up some things, I think people will be more interested in getting back into the stock. How high will it go? I'm not really sure. I'm targeting maybe 60. So I'm looking for 10 to 12% increase. And so having the stock for a month and getting, if it's 10 to 12 and I've already got 2.5, then we're talking 12 to 15% return in 1 month. I'm okay with that. And again, that's just seasoning, because the rest of my investments are not like this. It's not based on an event. It's based on some other process. That is actually pretty boring. My other one is Pinnacle West. I have 1,400 shares of that. It is 6.7% of my portfolio. So what do I say to a lesser degree? I have Pinnacle West in my portfolio anyway. It's not going anywhere. However, I ramped it up, and I ramped it up because there were two things coming. And one of those was their rate case. So that has happened, and it was very positive. It was beneficial. So I'm up a little bit, 3.4% on the shares. I was expecting more than that, but that wasn't the only reason that I did that. I'm also expecting over the next few months for the Fed to begin to lower interest rates. When that happens, highly capitalized businesses like utilities, this will not be unique to Pinnacle West, but for Pinnacle West, for me, there were two events. So why didn't the rate case impact the stock in a positive way, big way? It's because they decided to issue more shares and they created some dilution. So I was not expecting that. So I kind of missed on the first one, but I'm pretty sure the second one's going to come through. So I'm kind of holding on Pinnacle West for a while. And then, once all of that shakes out, then I'm going to bring that down to a normal weight in the portfolio, which will probably be 3 to 3.5%. So anyway, those are my gambles. In the short run, the stock market is a voting machine, yet in the long run, it's a weighing machine. So every day we're buying shares on the market, and people are buying what they see trending. They're buying what they believe is going to happen. But in the long term, it is about cash, and it's about the ability to generate cash. So Graham and Buffett both, I think, are quoted in this. And then I guess the last point is to just be honest with yourself. Is the stock market, or is the stock that you're buying, is it an investment or is it a gamble? And if it's a gamble, own it, right? I mean, just like I'm doing with these two stocks, I know what I'm doing there. And I also know that I've got 25 other holdings that are not gambles. They are investments. So, it's good to have a little seasoning in the portfolio sometimes. So I share all that just to say, sometimes you got to have a little seasoning. And it's important to know the difference. So back to this question from Buffett. Do you guys think it's okay to lose money on a stock? That's I'll just kind of throw that out there. So as you guys are responding to that, I'm going to see who else here. So let's go ahead and get this off the screen. And Shaping has been here since 12:32 today. So 6.5 hours on the broadcast. Dude, that is fantastic. You are certainly committed. No, I'm just joking. I know you came in and did that and then you left. But anyway, and Shaping also says that some stocks are so risky that even buying shares is a gamble. That is true. And that's if it's not following your methodical, boring process, then it's probably a gamble. That's just the way to think about it, or at least the way I think about it. Okay, Pat is he has internet tonight. He's down off the Gulf Coast somewhere. I'm not really sure which island he's on, but it is great to have you on, Pat. And it looks like 2 more weeks he'll be home, where he has some really good internet. So he'll be joining us much more consistently after that. Slammer 6789 is here. Welcome to the program, my friend. It is not as fun to watch the replay, is it? Yeah, I agree with you. Fenders 53 is here. Mr. Income, as he is also known. Welcome to the program, my friend. Brad is here. And let's see. El Dynamico has made it from West Sacramento. Welcome, El Dynamico. We got Jacob in the house. He says, thank you, Kevin, for helping me not waste money on a stock I knew nothing about. I'm only 24, but I'm trying to learn everything about stocks, trading, and crypto so I can get a head start. Jacob, that is fantastic. So a little bit of history on me. I didn't really get serious about investing until in my 33. I was about 33. So the fact that you are beginning at the age of 24, but also beginning in a way that where you're teachable and you're going to be learning how to do things, and probably more importantly than what to do, it's more important to understand what not to do. Then you are going to be very, very successful. And I really am glad you're here. So stick with it, my friend. Pretty soon you'll be sharing things that we should be looking at. So welcome to the program. Ex-Dividend Dad. X to the what? X to the who? Ex-Dividend Dad's in the house. Always love to see that coming in. Greg from Southern Cali is on the program. Welcome, Greg. Kevin Mendoza. We now have Kevin squared. We will see if we have more Kevins here soon. Suzuki Man, it's good to see you, my friend. Jim Betts made it late. Darn that time change. I really don't like the spring forward. If I had to confess, I would confess that I really do like the fall back. It's like I get an extra hour. But man, this spring forward thing is for the birds. So. Okay, Fenders, Mr. Income says that says that I got a message from somebody else. So almost everyone has to try their luck. It's fun. Keep your head and compartmentalize some funds for that. Invest most of your funds and you will very likely win in the long term, in my opinion. I think that's exactly right, Mr. Income. I think as people try to invest for the future, and they're investing the lion's share of their portfolio. And when I mean investing, I mean not gambling. They're investing their portfolio in a way that is kind of boring and one that they're not trading in and out of. I think that in the long run, you saw that chart with the S&P 500. In the long run, it's going to be a winner. All right, Kevin Mendoza. I usually hang on to stocks for a very long time. I don't mind too much if the price drops because I didn't buy it to sell it. I just hold them. I think that works. And I get to where I do something that is so first of all, I usually will buy stocks to hold them long term as well. So ADM is a very rare thing for me. But there's also times when either a stock gets way undervalued from my perspective or way overvalued. And so I will usually, and I'm very slow to do this, but I will usually, if it's very, very undervalued, I will raise my investment level in that to get it to around a 5% investment versus about a 2.5 to 3%. And if it's way, way overvalued, then I will usually drive that down a little bit to 1 to 2%. And then, but I still hold the stock. I'm just as it ebbs and flows, I try to capture some of that, but I never get out of the stock in general. So I agree with you. I hold the stocks, but I do a little bit of movement. So Michael Swami's in the house. He said he sought seasoning with Intel and APD, doubled down when they took a hit. Also did an arbitrage play on ATVI. I'm not familiar with ATVI, but I'm familiar with Intel and Air Products. And so yeah, when both of those went down, those were great investments. I did not invest in Intel because I just don't think their strategy matches what I want in my portfolio. But remember, every stock is worth something. And so when Intel went from mid 40s down to the low 20s, it was very enticing to get in. But I made myself not do it because I just didn't want to invest in it. I didn't want to have it long term. I didn't want to gamble on it. I just wanted to invest my funds in the companies I wanted to invest in. So Intel for me wasn't worth gambling on. Air Products I don't see as a gamble at all. I think they've got a great balance sheet. They've got great profitability. But the volume is not going to increase like it was once thought here in the near future. So I think picking up some of those when they were, I bought some at 219, and really happy I did because I think it's nearly at 250 now, just a few weeks later. So I think Michael, that's a great move. I don't know much about ATV. I don't know anything about it actually. But if it's the same as Intel and Air Products, those are good moves. So Pat says, as long as the dividend is solid, the fact that the price moves does not bother me. I think that's great too. A lot of times us as dividend investors, we like that yield on cost. And as the stock price moves and we maybe buy a little more when it comes down, we'll get a little bit higher yield on cost. So yeah, Shaping says buying and holding with a long-term mindset is his favorite. It's my favorite too, my friend. I think that's how we win. And if we're trying to win on a daily basis, and I know on our Discord, by the way, if you're not a member of the Discord, go into the comments in this video and join us in there. We're talking about investments all day long. And I know it sounds boring, but it's really not. So this buy and hold, and I forgot really where I was going with that. But anyway, it was probably a good comment. I just have no idea where it went. It just left. So I've been burning today. I had a big pile where we've been cutting limbs and stuff like that. And I mean, it was huge. And so I still smell like smoke, actually. So good thing this is live stream and not live smell stream. So you guys are being shielded from that. All right. Greg says that Buffett did also say he doesn't lose money because he hasn't sold it yet. You lose it then. I sell when my thesis changes or when management goes wonky. Greg, that is exactly the way I look at it. If management makes bad decisions and as you say, goes wonky, that to me changes the whole reason I'm investing. And as you guys know, I have 5 pillars, and I won't go through those. You've heard me talk about them a lot. If you don't know what that is, I do have a video or 2 on that. So, but yeah, when that investment thesis changes, all bets are off, man. It's time to either decide that I'm going to continue investing in it or move on, whether I'm making money or losing money. Yeah. So other than that, he holds. That's good advice. Good morning, Billy. Billy, good morning and good evening. So Billy is overseas, and it is morning for him, and it is evening for me. So Billy, it's great to have you on the program tonight, my friend. Hopefully, you're having a nice cup of coffee as I'm drinking water because I don't want to stay up all night. All right, Mr. Income, losing money stinks. That we should get a T-shirt. Maybe that should be the new mantra for the channel. Losing money stinks. I love it. But I will cut my losses if the story truly changed. Regroup, more due diligence. Nothing stopping me from re-entering with updated facts later. Yeah, absolutely. That's a great approach. Kevin says he's in Arizona and we don't do the daylight savings things. That's fascinating. And we lived in Indiana for a while years ago, and it was by county in Indiana whether they actually followed daylight savings time or not. The county we were in did not follow daylight savings time. So we were halfway between Evansville, Indiana, and Louisville, Kentucky. So half the year we were on Evansville time and half the year we were on Louisville time. So it was just really weird. But glad to hear that, Kevin, because it's a bummer, especially in the spring. Probably me sending you a chicken picking pooping idea on Instagram. Yeah, that's probably what it was, Jim. I saw something pop through and it made a noise and it distracted me, and I lost all thoughts that I had in my head at that point. So, oh, we got Chris, also known as Kamarai. Great to have you on the program, my friend. He's my fellow Pinnacle West investor. So great to have you on the program. John J has made it. That is fantastic. I haven't seen you in a while, buddy. I see you not only raised your investment level, you raised your commercial time for a full minute and no way to skip it. Oh my gosh. So, yeah, so let me talk about that for a second. So there's a way when I build these, whether, it'll ask me if I wanted to do the, what's that called? The advertising stuff. And I always select yes, right? Because at the end of the day, I'm going to talk about other things here. This is a great comment, John. I want to park here for a second. So I select yes to do the ads, but I also select the least intrusive, and that's not what it's called, but it's. I want them to be. I want them to be the least that they can be, right? So YouTube decides when they do it. They decide how long they're going to be. I don't have any skin in that game, but at the end of the day, it's also not a big deal. I don't know why they wouldn't let you skip a full minute ad though. That's weird. But anyway, I don't. I guess from my perspective, it's not a huge deal, especially if it'll let you skip it to, give it the 5 seconds and click on it. But where I want to go with that, though, is this. And that's that. First of all, I'm a very small channel. And secondly, I don't need the money from YouTube. I don't do it for the money, right? I do it because I want to meet investors like you guys, and I want to create this community where we work together and win in the stock market. So that's why I do this. But it's an opportunity for me to raise some funds. So what am I doing with those funds, and how much are those funds? You'd be surprised. I think I get about $25 a month from YouTube. So you can see that. I mean, that's like, eating out once, right? So it's not a huge deal for me. But what I've been doing, and the reason I want to keep this going, is I have been putting that money aside because they only pay me when it's $100, right? So when they pay me, I got my first payment last August, and I think I've got some funds now built up. So anything related to social media stuff, I put in a special account, and I've created an investing account for that money. And so my goal with that money is not to invest the way I invest in my big portfolio, but to try and make money as fast as I can. So I want to begin to share that portfolio with you guys, but I want to be careful how I do that, because I don't want you to take those investments and say, oh, this is how I'm going to raise funds. So I need to be careful about how I do that. And I want you guys to know that it's not how I would normally invest, but I think it's going to be kind of fun. And so if you think that is worthwhile to actually see that account and watch it grow, and I've been tracking it, for this year. I actually started doing it on about the second or third week of January. And it's done okay. So anyway, so the point of this is that with those ads comes maybe a couple of cents that will go into this account, and it'll help, create some revenue that can be invested in that account. We can buy some more shares in that and actually watch it over time. So hopefully that makes sense. And, let me know your thoughts on that. Either if you're watching, live here in the live stream, or if you're watching later, give me some thoughts here on the video. Or if you're in the Discord, hit me up in there, because I'm in there every day. All right. So we've got Michael saying ATVI was Activision. Okay, I got it. Yeah, they I remember that. I think that acquisition by Microsoft was brilliant. That was really what began to make me, a big fan of Microsoft, was that. Okay, Billy's got Air Products. He says this is #1 holding. Buddy, I think you're going to do well with that. Air Products is probably a normal weight, a little bit more than that in the portfolio, but I think you're going to do well. Yeah, my Activision Blizzard. Yeah, absolutely. Okay. I'm going to move down through some of these. Okay, Miguel Ramos is in the house. Hi, Kevin. If you had to choose a food stock to hold forever, which one would you pick? For example, SJM, is that that place out of Ohio? Smucker, I think that's Smucker, Hormel, Tyson, or Campbell's Soup. So out of those, I have out of full disclosure, I've owned 3 of the 4 at one point in time. So I've never owned Hormel, HRL. I have owned Tyson, I've owned Campbell's Soup, and I've owned Smucker's. If I had to pick one of those, I would probably end up picking Hormel. Or it could be Tyson. I don't know. I think Smucker's and Campbell's will be pretty much in a certain trading range. I don't see a huge growth trajectory for them. Hormel, Tyson, maybe a little bit more, but right now I'm not invested in any of them, and I don't think I own any food stocks at all. I would have to look, but off the top of my head, I can't think of any. Maybe I do. Maybe you guys may know more than I do what's in my portfolio. So let me know. Business with Redbeard. I've never seen you on the program before. I am so glad you're here, dude. So 30-year-old investor and got a kid on the way. Congratulations, man. That is fantastic. 15% of my portfolio is SCHD, and I consider that as a bond alternative in case we need something quick. Yeah, I think that's not a bad thought, because SCHD has a high dividend yield. It really has historically had a pretty high dividend growth as well. Good combination there. But they've been struggling as of late. And one of the things that I do for those who join me on Buy Me a Coffee, I will actually show you each week not only my portfolio, and not only tell you when I'm making trades in the market, but I'll also compare my portfolio with the S&P 500, with SCHD, and with DGRO, just so you can see how that's playing out. And so, yeah, that's not a bad thing. I think SCHD gives you some good diversification, and it is high income portfolio. So that's not a bad thing. I will say this though. So first of all, 30 years old, first kid on the way. Congratulations, man. I would say this: if you don't have an emergency fund, I would pull some of that money out of there and create an emergency fund. That's what I do. Not only do I have my what I call my operating budget, but then I have an emergency fund, and that really falls between my operating funds and my investments, right? So I don't have to pull from my investments as something comes up. I have this emergency fund sitting in mine just sits in my checking account, but maybe that's not the best thing to do with these interest rates higher. But at the end of the day, that cash is there. So I don't have to jerk around with my investments a lot. So that would be the only thing I would say there. But great job, man. Great job. Let us keep us posted on when the little one arrives. We'd love to hear about that. So Miguel has, he says, if you had to choose, we already answered that. Maybe it posted twice. So Jim sold all of his sub 4% dividend yielding stag position and moved everything to Vici, Main Street Capital, Realty Income, and ADC. I think that's Agree Realty, among others. So yeah, those are definitely going to be higher returns. And I think here's what I think about Vici and Realty Income and ADC. I think that all of those REITs are going to probably see a little bit of tailwind as interest rates begin to come down, just like the utilities will see, because the REITs are highly capitalized entities. So I think they're going to see a little bit of tailwind there. I choose to play that more in the utility space, but playing it in the REIT section is not a bad idea either. And you sold the Stag investment at a 6% profit. So great job, man. Yeah, thanks for sharing that. Google knows too much about me when my ads are prepaid funeral arrangements, beard coloring, and Depends undergarments. Yeah. I don't get to pick the ads either, brother. So, that's good. Thanks for sharing that. So Michael says there's a distracting level of ads on this live stream. I've been interrupted 5 or 6 times. That is weird, because I select on purpose the one that impacts you guys the least. So maybe I should just take them off this live stream. I mean, for future ones, I can't get out of this and go do it now, but I appreciate you guys sharing that with me, because the last thing I want to do is have the idea of this is to have a group of people who enjoy being together, but then these ads are popping up and you can't enjoy it. So I think next week I will take the ads off. So it's probably 50 cents, right? So that's So next week, I will make the commitment to take the ads off. You guys let me know if that works better next week. Sound good? So Greg says he can hang with a commercial or two. Your time putting this channel together and the research you do is top notch. I appreciate that. I enjoy doing it, and it's really because I want to get to know you guys, and my goal is for us all to win. This is not a win-lose situation. I want us to all win together. So I appreciate that, my friend. Smuckers is SJM. Yeah, that's I've owned Smuckers before. I was and I knew what it was, and I knew where it was, but I could not think of the name of it. I think it says I've been breathing smoke too much today. Yeah, so even Mr. Income has gotten an ad. So I'm going to try next week to not have ads and see if that's much better. Let's see what John Jay's got going on here. What is strategy around drawdown on this highly inflated, armed according to some? I'm not sure I'm following that. John, if you can help me, I mean, you've added a word here called hedging. Drawing down this highly inflated. I'm not sure that I'm following that, my friend. So give me something additional. And, I got an opinion on everything. So if you don't believe me, just ask me. Michael says, no idea, booted out of the stream by about 1 minute ad. Yeah, that's a bummer. So next week that won't happen. So we'll test it next week and see how that works out. I know Smuckers recently bought up Hostess. Yes, they did. Twinkies are yum. Yeah, especially, I don't know if you've ever had a deep fried Twinkie, but boy, is that good. Let's see. SEHC is better than bonds. Yeah, I think there's a lot of good things there. Let's see here. Mr. Income needs some likes. Many more than 4 people watching. Yes, there are. So yeah, that's great. I appreciate you mentioning that. So Business Redbeard, thanks, Kevin. We also have a 3-month emergency fund too. That is fantastic, man. That was the only thing that was causing me a little bit of hesitation there, but I think SEHD is fine. It's for your level 2 emergency fund. I like that. All right, Jim. Let's see. I don't have any ads other than the first one. Maybe you're taking the ad bullet for all. Yeah. I think I could joke around with that and say that I had targeted Michael Swami for all of the ads, but I can't do that. YouTube does that. I just select whether I want a lot of ads, medium ads, or low ads, and I pick the low ads. So we'll see what happens next week. Let's see. Miguel wants my opinion on Starbucks and Mondelez International. So, I haven't done a stock thing in a while. Actually, I don't think I did one last week at all. So let's do that. So Starbucks, how did that get up there? Okay, so let's go to, I'm going to stop sharing this, and we are going to share this. And you guys know that one of my favorites is Simply Safe Dividends. So I usually start there, and it's not because it has better information or it's a better tool than the others that I use, but it's just better organized for a video. So because everything's just right there on the one page, and I don't have to flip back and forth from screen to screen. So let's look at Starbucks, SBUX. I have not been keeping up with Starbucks because I don't own them. Dividend safety is a little bit low, which is 67. I was not expecting to see that. Let's take a look at some of the other things here. So they did that. Oh, that's been over a year, almost a year ago. So they're at a safe dividend, but it's not as high as I thought it would be. Their payout ratio is around 60%. But I really do like this dividend trend that they're on, and that they've done it for 13 years. Let's look at earnings payout ratio. The earnings payout ratio is staying pretty flat. Actually, it's coming down a bit. So what that means is that the dividend raises are well in line with their profitability. So I like to see that. Their free cash flow payout ratio is pretty flat as well. Earnings is doing well. And let's look at their, so the shares outstanding, they're buying back a lot of shares, it looks like, or at least were until 2020. And then they have slowed that down quite a bit. They've got a return on invested capital of 36%. That's fantastic. Net debt to capital is 0. That means that they have a lot of cash. That's what that means. Their investing coverage is 10, so that's good. So I think the financials look good. My thoughts, though, from an investing perspective in Starbucks is a lot is going to depend on their investments in China. And if their China investments begin to bring growth to the company, then I think their growth is going to happen. I'm waiting to invest in Starbucks until I get some clarity around their growth prospects. There's one pretty much on every corner in the U.S. So if they can bust into the China market, then I think Starbucks might be worthwhile. Therefore, I'm not investing in them. But I've been wrong before. And the other one was Mondelez. I've looked at them before, but it has been a while. So let's take a look at Mondelez. MDLZ is the ticker. They've got a 66 safe dividend rating. Starbucks is only 67, so that's good. 2.35% yield. They looks like in 2012, 2013, they cut their dividend dramatically. I'm not sure what caused that, but since then, for the last, let's say, 10 years, uninterrupted, and they've grown their dividend, but for the last 10 years. Earnings payout ratio is around 50%, so that's very decent. Earnings per share, I love that up and to the right. Those look really good. Shares outstanding are coming down slowly. They do have a lot of shares outstanding, though, 1.4 billion shares. Their sales looks like they came down around 2016, stayed flat for 4 years, and then have begun to grow. So that's a positive sign. Return on invested capital is around 12. That's pretty decent, actually, especially for the food business. And I think they're in the food business. Let's take a look. I'm going off memory here. Yeah, they manufacture, market, and sell snack food and beverage products in Latin America, North America, Asia, the Middle East, Africa, and Europe. Biscuits, baked snacks, cookies, crackers, salted snacks. Okay, we get it. So let's look at one more thing. We want to look at net debt to capital. They got a 39% debt, but a 11 on the interest coverage. It doesn't look too bad from a food business perspective. So that would be, and I think it would be worthwhile. I'm not sure, I haven't done any research on what their growth prospects are, but I think that would be the next thing that I would do. Let me get back to where I was. There we go. Michael Swami says he's bulletproof. He's still hanging in. Man, I appreciate you getting your Kevlar vest on, buddy. I appreciate it. Okay, Al Dynamico also sent me an Instagram message. So if you're not following me on Instagram, and since I've set the Discord up, I have really slacked off of Instagram, and I apologize for that. I will fix that. I just don't even think about it because I do so much on the Discord. So, John, okay, you meant to say, what is my strategy around hedging against this potentially highly inflated stock market? Yeah, that's a great question. And to be honest with you, I don't I don't hedge because it's just not something that I do. You could get into futures and options and things like that, but to me, it's I'm investing in companies that I believe for the long run are going to produce income and capital gains for me, and having some volatility is not a huge deal. So, do I want to try to capture the height here, and then not really. I'm just not that smart, to be honest with you. I own these companies because I'm an investor, and I really don't do any hedging to speak of. I did buy a couple, or I did sell a couple of puts a couple of weeks ago, but I have actually bought those to close. And it was just really more to test this new account that I have to make sure it could actually do options trading. But that was really the only thing that I've done. So, I mean, if anybody else is doing some hedging out there, then let us know in the comments. Yeah, that's good. Let's see. Okay, Joe here just got on. He'll watch the beginning later. Hello and thank you, Kevin. Thank you, Joe. I appreciate you being here. And it sounds like Michael has taken all of the ads for everybody, so you'll probably be pretty clean here, my friend. So welcome to the program. Jim Mondelez wins out a little bit over Starbucks in the Seeking Alpha side-by-side comparison. That's good to know. Yeah, they look pretty similar to me. I think the growth prospects on either one of them is going to be a bit of a challenge from my perspective. All right. John J., I respect your opinion, and I would love to hear your thoughts on NXST, Next Star Media. My friend Russ Knopp from Dapper Dividends, he was on last week, and he loves Next Star Media. So let's take a look at it. I don't own them, just for full disclosure. Next Star Media. They are a borderline safe dividend. They are yielding around 4%. Let's see who they are. First of all, they operate as a diversified media company that produces and distributes engaging local and national news, as opposed to those companies that have those non-engaging news and local and national news. Content across the television and digital platforms in the U.S. It owns, operates, and programs and provides sales and other services to various markets, TV programming. So they're basically an advertising group. And so let's take a look at some of the numbers. So payout ratio is 54%. Their forward payout ratio is 26%. So that is a pretty big difference. They must have had a rough year. Look at this dividend growth. The dividend growth is incredible. Makes me wonder why they have a 60 dividend rating, because they are growing it like wildfire. Look at this, 27% over the last 10 years, 29% over the last 5 years, and their latest was 25%. So that, oh, wait a minute. Let me take this off the screen so you guys can see better. I'm looking at it on my screen, and it doesn't have that on there. Hopefully this is better. Sorry about that. So let's see. Let's look at some of the data here. Their earnings payout ratio is getting much better. We'll see what the earnings forecast is here in a minute. The free cash flow payout ratio is pretty low. I think that's fantastic. Look at their earnings per share. Last 12 months was $10 per share. And next year, next 12 months, it's projected to be $26 a share, which is not too far off from 2022. So it looks like 23 was a rough year for them, and looks like they're back on track in the next 12 months. So that's good. They have been buying back some shares, so they now only have 35 million Remember that company a while ago had 1.4 billion shares. They only have 36 million shares outstanding. Total sales have flattened out a bit, so it makes me wonder where the earnings are coming from. Are they quality earnings or not? That'd be a great question to ask. The return on invested capital is not that high, though. That'd be a challenge. I mean, if you think about, at least theoretically, right, the theory around return on invested capital is that you would compare that to their weighted average cost of capital. So if the more gap that you have, the more return on invested capital that you have over your weighted average cost of capital gives you an indication of what the future earnings of the business are going to be. So they can, every time they add additional capital, they should get more return for that, theoretically, right? So for whatever reason, they are down around 7%. And I would think, at least in this interest rate environment, the weighted average cost of capital would be somewhere in that neighborhood. So that tells me that they're not making enough money, at least right now. And now we saw that was changing next year. It looks like it's going to double. It's going to be similar to 22. So you see that was around 13%. So that's certainly doable. If next year their earnings come back and this return on invested capital improves, that could be okay. Debt to capital, wow, 76%. So that means that $76 of every $100 invested in the business comes from debt. And there's a lot that can cause that. I don't want to, alarm anybody by that, but that's pretty high. And their interest coverage is really low. So I think they do have a lot of debt and they're having trouble covering that. So, 1.77 versus a target of 8 is pretty low for that. So, yeah, I mean, there's some things to like about Nexstar, but there's also some things that cause me pause. So I'm not gonna invest in them here in the next near term, anyway. Let's see, I got to figure out where I left off here, because when I take your comments off the screen, I have to find it in the comments to find out where I was. Yeah, so did Simply Safe on it, and so that's what that is. Okay, and your take. Can you take a look at AbbVie? Yes, I can. I used to own AbbVie actually. And I ended up selling them. It'll be interesting to see what they are running for right now. Let's see. Oh, it's already up. Never mind. So ABBV. AbbVie's got an 80 safe dividend score, 3.45. When I was buying AbbVie, it was up around 4.5 to 5% dividend yield. And let's see what the price is. Oh, wow. It's about 180. I think I sold somewhere around 150 or something, along those lines. So it has gone up even since I sold it, a year and a half or so ago. On March 4th, they were upgraded and they published a note on that. They went from 70 to 80. So there's some, AbbVie has solid execution, positions firm for sustained growth beyond Humira. So, Humira is a drug that came off of patent. And so the theory is that they would lose a lot of sales with Humira, and then they needed something to come behind that to continue the growth of the company. Sounds like they may have those. I'm forgetting what drug was right behind it. I think it started with an S. No, it was an R. Rinvoq. So Rinvoq was the next one. Oh, Skyrizi. That's what I was thinking of. So Rinvoq, Skyrizi, evidently are coming through for the company. So that's good to hear. So I mean, let me just back up and look at some of the numbers here. So you can see what the dividend has done. And they're a spinoff of Abbott Labs, as you see here. That was done in 2012. So, you'll notice that their dividend, let me see where it is. Their dividend growth streak is 52 years. Their uninterrupted dividend streak is 100 years. You'll notice that they just started paying a dividend in 2013. And what that means is they had this spinoff, and they also got to carry their predecessor's streak forward. So that's what that means. And let's see. Let's look at some of these numbers. Earnings payout ratios in the mid 50s. That's not bad. Earnings per share. Look how it's dropped off. It's dropped off, a bit. So I was not expecting that. I thought it would actually be growing. So free cash flow is down as well. Shares outstanding, pretty flat, which we would expect. Return on invested capital is not bad, 24%. And let's look at their debt. Net debt to capitals are 82%. That's a lot. And interest coverage is a little less than 8, so that's not too terribly bad. Yeah. So from a yield perspective, it's not bad. I just don't know that the growth is going to be there. I know that Renvoke and Skyrizi are pretty decent products, but man, Humira was like the knockout punch. So, replacing that is going to be a hard road for them. That's why I actually sold out of them. So those are my thoughts, Pat. Glad you are here, my friend. Jim says Oreos. That's all he needs to know about Mondelez. Absolutely, Oreos and milk are really good. KLG Suzuki Man wants to know about KLG, so I will do that one, and then it's actually we've hit the 1 hour, so I will do maybe this one, and we'll see what everybody else has got going on. Oh, Kellogg. This is one of the spinoffs, WK Kellogg. I think that's the cereal company. So let's go ahead and pull that up, and I will put it back on the screen here. Take that off. So they've been around too short a time to get a dividend safety rating. It's only been a couple of 3 months, maybe. Their dividend yield's around 4.4%. They're trading around, $14.50. So it's really going to be tough because they don't have a lot of information here because they just haven't been around long enough. And this information that is here is going to be based on the pro forma statements that were issued as part of the spinoff. So I'm not sure how much of that I would trust anyway. I'm sure it's as accurate as they can get it. But you take a company that's been reported together, and then you slice off pieces of it, and you have part of it go with one, part of it the other. You're doing the best you can, but you don't know if that's really completely accurate. So I don't know, man. I think I'm going to wait on WK Kellogg. It's I think I'm going to wait on them, my friend. I don't they don't excite me a lot, to be honest with you. All right, so let's see. Yeah, so this is a good point, Jim, and that's that Russ likes the idea of the ad revenue from the election cycle. What I will say about that is that investors already know that's coming. So that's not a big surprise. Investors don't wait until the earnings are released for the election cycle and go, oh, wow, we had election ad revenues. So investors know that's coming. My guess is that's already priced into the shares. So that wouldn't be enough to entice me to go into that. But everybody has their own process, and but that would be my perspective. Yeah, so business with Redbeard, his time horizon is 25 plus years. I'm kind of hesitant to invest in mature S&P dividend companies because I'm kind of nervous. There's not much growth left. Overthinking it? No, I don't think you're overthinking it at all. I think there are some. I think there are some good quality companies out there that are not these behemoths like Johnson & Johnson and that you're thinking of here. So I think there's a lot of opportunity there. I invest in some of the behemoths, but I also, I don't, I have other investments as well. So, yeah, I don't think you're overthinking it. I think you're thinking about it correctly, actually. So that's good. Greg says NXST is just about all local basic channel news, some sports, and should get big ad revenues from presidential campaigns. Yep, I agree with that. So, Business with Redbeard says, I've kind of tilted towards boring mid cap companies that are low dividend but sturdy and under the radar, like Mueller Industries and a plastics and steel manufacturer. Hey, one I would give you to look at, do some due diligence on, is Graco Industries, ticker symbol GGG. It's trading right now, and it's like it's all time highs. But it's something that you can take a look at and keep an eye on it and see if it dips a bit to buy some more or to buy some. It's one of these like Mueller Industries, so I think you may enjoy that. Let's see. Yeah, so El Dynamica's having commercial issues as well, or ad issues. Yeah, so I think that's going to be about it, guys. So I really appreciate you guys joining. I enjoy these, and so you get the spiel. If you want to join the Discord, the links in the description below. If you want to go to the Buy Me a Coffee thing, that's below as well. There's a lot of stuff in there in the notes below, so just be sure to check all of that out. And at the end of the day, it's just been a fun time to get with you guys and, just kick some stocks around. It's just really kind of fun to me. So I really appreciate you guys joining, and I will see you on the next one.